coming to practices and processes, right, Abhinav, as a deal maker, ye dil mange more, right? So give us a sense of perhaps some of the aspects which the Indian regulator can adopt, which are present in overseas jurisdictions, but may not be part of the current SEBI setup, whether it comes to book building, whether it comes to how much skin anchor investors have in the game. Can you illustrate with a few examples? In fact, Hong Kong also last year changed the rules of the game.
Correct. So I would say, look, for IPOs, the thing that is most important is flexibility. The ability to have a flexible regime so that you can react to market changes. Remember, an IPO process is a bare minimum 2 to ideally 4 week that you are stuck with a single valuation number, whereas the market can go up, down, and you have to try and book build there. That's the single biggest challenge we face. So the biggest benefit if we can provide is how much more flexible we can make the process. Now, of course, the regulator has continued to work on that path. The minimum public shareholding, the minimum float required upfront, the rules that came out last night are all in that same direction.
That's right.
But just to give you some examples, despite the way the markets are, in the US right now, you are still seeing IPOs getting priced. In fact, just earlier this week, a Japanese company listed in the US called PayPay, raising about $900 million. They had the flexibility without changing the issue dates to actually price their IPO $1 below the range, change the price, the number of shares or ADRs being issued. So those flexibilities in a public book build process allowed for a transaction, a cross-border situation to get listed in the US, even when the markets were so bad. So that's just a very recent example. I'll give you another example, and you talked about Hong Kong. Hong Kong has this concept called clawback for retail. And the way it works is, it actually makes the retail a more positively biased in the direction of how the book building is happening. So every IPO, for example, will start with, let's call it only a 5% retail tranche and a 95% institutional tranche. There's no HNI equivalent there. And then depending upon fixed number of subscriptions for retail, that retail tranche could actually expand to become 50% of the IPO. In other words, in a hot IPO, retail gets more. In a not so hot IPO, where you want institutions to actually own the stock and so that they could hold it for the long term, they actually take the more. So it becomes more aligned with how you want the stock to get concentrated in the
And these two aspects you think will go a long way in giving more flexibility to Indian issuers.
Exactly.
Well, we can only hope the government and the regulator is taking
away
note.
From retail. If retail shows up for our deals, they will absolutely get their full 35%. But equally, when they don't show up, you don't have the stigma that, look, the book wasn't subscribed.
Very, very interesting submissions, Abhinav. Manish, give us a sense, are private equity firms now warming up more to dual track processes, wherein you simultaneously pursue an IPO and at the same time you're also trying your luck with a stake sale? That's number one. It's a two-pronged question. And the second one, how challenging is it for a PE firm like you in the current environment to maintain the key metric of DPI, distributions to parent capital? At the end of the day, that's what matters to your LPs, right? Go ahead.
The second one's easier, and the two are interrelated, of course. The fact that we sold down 500 million in Vishal was cognizant of DPI, but not DPI for ourselves. You've got to think actually ahead. Creating DPI in these times is more valuable because our investors, if you avoid for a second the domestic, our investors firstly are global institutional investors who've had a huge shrinkage in liquidity because of what's happening in the rest of Asia, especially China. So they're very, very scarce of capital right now. So an additional dollar from us is worth a lot more than normally. So we shoot for DPI. The beauty about India today is DPI, there are three engines for us to your dual process. One is, of course, the IPO markets, and thanks to the domestic investors, SIP, large mutual funds, it's been on fire for the last 2 years. We also have a very active sponsor market, which is private equity firms buying and selling from each other. We sold one company to Warburg, another packaging company to Advent, one more financial services, Avas, a listed company recently to CVC. So there's a very active secondary market. When the market falls right now, the pricing in the secondary market, sponsor to sponsor, because of the liquidity in the market, is significantly higher. So you're right. That's the second one. The third one, which also for India is becoming critical, is strategic buyouts. Often companies globally are looking to mark India now as a pivot away from China, or they started with the Japanese 20 years ago, but now it's becoming commonplace. So those are fewer and far between, but you're still seeing many of those. As a PE investor, when we're looking at a company, we don't decide today, market is thing, let's do something else. That decision was made an investment. I don't allow an IC to be evaluated unless the team at the time of investment has a very good perspective on who the natural owner should be. Is it the capital markets? Is it a strategic? Is it a sponsor? And actually, the IC won't pass it until we get the names, if it's number 2 or number 3.
That's right.
My only point is, so it's not a knee-jerk reaction to what's going on in the... Our team would have had 3 options, worked on the most probable one, and frankly, if the market is as it might get to, so I don't want to be rosy all the time, this could get to a real amount of gray for the next 6-7 months. You know, we then say we defer the sale, because again, remember, we are a 10-year product. But the discipline of exit should be such that you realize the money 3 months ago, not be forced to selling today.